Hey Bowtie Nation, Joseph Hogue here. Thank you for joining us for another one of these Monday market updates before the market opens, 9 a.m. every Monday morning, getting you ready for the week. All the stocks I'm watching, the news that could highlight the week, and the topic, and what a topic we've got for you this week. You know, ChatGPT and artificial intelligence is all the buzzword right now, whether it's going to replace all humans out of their jobs and whether they can pick stocks better than you. So that's what I want to talk about today. Stick around though, because then we'll be giving you your market update, get you ready for the week on that news to watch, as well as some very important news out of the Fed interest rates this week, as well as the jobs report, and 100 stocks in the S&P 500 reporting their earnings this week. So it's going to be a very busy week. But I want to jump right into this topic though, because with this new ChatGPT, it seems everyone is talking about artificial intelligence. While the dialogue produced on the software is really interesting, can it really do as much as it's promised? Can it pick stocks better than people do? And that's a question posted by a journalist on Bloomberg just last week, asking ChatGPT to create a market-beating ETF. And here's what it said. Here is the actual response back from this artificial intelligence program. And it is crazy. It says here, "It is not possible for me to design an ETF that will beat the US stock market because the stock market is unpredictable and past performance does not guarantee future results. Additionally, the composition of an ETF should be based on a thorough analysis of market and strategy for achieving specific investment goals, which I do not have the information or expertise to provide. It is important to consult with a financial advisor before investing in any ETF or stock and understand the potential risks and rewards of the investment and ensure blah, 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 blah." And folks, this is where we find ourselves with artificial intelligence right now. Okay, I should put that in quotes because it's not really doing much anything. It's producing some gold standard bullshit, right? But lays bare the weakness in AI where it really is right now. You know, AI isn't good at the actual analysis, actually getting smarter and doing this kind of things. It can scrape the internet and reproduce a lot of that intelligent sounding dialogue, but it's not really doing any critical thinking of its own. Okay, it's done well at producing those essays on management and, you know, legal in the legal field, which is why all the journalists, all the managers are scared shitless right now because it could replace their jobs, but it's not yet synthesizing real information and creating anything new. In fact, there have been several other ETFs that have tried this AI, this artificial intelligence theme. One here is the AI Powered Equity ETF, that's ticker AIEQ, holds $102 million in assets and uses a quantitative model running on IBM's Watson platform to assess 6,000 US stocks. The program says it scrapes regulatory filings, news stories, sentiment gauges, and valuation models to really position across stocks. There's also this AI Enhanced Value Fund, the AIVL. That's a larger one at $419 million in assets and uses that quantitative model to select stocks based on value characteristics. And we can look at a chart of actual returns on these two AI funds, as well as the GSPC index here, the S&P 500. So in the purple there is the broad stock market index, the S&P 500, against in yellow that value AI fund, the AIVL, and then green here, or it's red because it's negative, the AIEQ. And what we're looking at here is a 1-year performance, the AIVL, so that value artificial intelligence value fund has outperformed with about a 2% loss against about a 9% loss on the overall market, the S&P 500, as well as that AIEQ fund. And you can see here on the 2-year chart that AIVL, the artificial intelligence value fund, has again beat the market, a 13.5% return against a 9% return for the S&P 500. Again, the AIEQ, the other AI fund, is underperforming by quite a margin, losing about 16% over the last 2 years. But that outperformance falls apart in the 5-year period over the longer term. The S&P 500 here has risen 41% over the last 5 years. That is against a 15% return for the AIEQ, and then just a 3% return for the AIVL. But now, even more important than that long-term underperformance of these so-called AI funds is if you look at the 1-year outperformance of the AIVL, of that artificial intelligence value fund, I think it's more due to its value bent than any real AI-powered stock picking. If we add in the Vanguard Value Fund, that's ticker VTV here in pink, and this is just a straight stock fund of value stocks, it produced a similar return, in fact a better return, losing just 0.5% over the past year versus the 1.9% loss on the AIVL, on that artificial intelligence value fund, and they were very closely correlated. If you can see here, the pink and the yellow lines here, they follow very much closely to each other. That AI powered value fund, and then just the straight value factor fund. So what I think is going on here, rather than any kind of like machine learning or artificial intelligence in these programs yet, is these funds are basically just using very strong computers to scrape for value factors or growth factors. This is basically just a value fund scraping and analyzing for value stocks rather than machine learning and getting smarter. Okay, if it were a true AI powered fund and machine learning, you would expect it to maybe start correlated with that Vanguard value fund, but then to break away and start outperforming that fund over time as well as the machine, as it becomes smarter, as that program becomes smarter in artificial intelligence and finds the better value stocks than even the Vanguard fund. We haven't seen that though. We've seen very close correlation. We've in fact still seen the Vanguard value fund outperforming. So that tells me I don't think there's a whole lot of machine learning or that AI going on still in these funds or in any kind of those the stock picking AI power. Now I want to turn it over to our Monday market update. Huge week for stocks this week. 102 stocks in the S&P 500 index reporting their earnings. Going to be a big week for earnings. Going to be a big week for the Fed announcing its interest rate decision as well as the jobs report. So first we're going to start off with Advanced Micro Devices, ticker AMD. It's expected to report a 27% plunge in its earnings to 67 cents a share. That would be against a 14% expectations for increase in revenue, 14% revenue higher to $5.5 billion when it reports on Tuesdays. So again, that huge difference in revenue increases and earnings decrease. Expectations for profits here, I think, are overly negative, and the company should have no trouble beating those earnings. Of course, it's what it's going to say for the year ahead. There is no doubt we are seeing a slowdown in the semiconductor market. We talked about that last Friday in our This versus That series. The report follows a massively horrible report by Intel on Friday with its earnings. As I pointed out in our This versus That matchup for AMD, a lot of Intel's problems are of its own makings, though. Okay, trying to launch a fabrication service, missing its design deadlines for its chips. I think AMD continues to benefit from Intel's mistakes and add market share, take market share in that data center segment. I'm going to leave a link to that video in the description below. Make sure you check that out for that comparison of AMD versus Intel. The week before we covered AMD versus Nvidia. Even though semiconductors are looking very weak here, it is a cyclical industry. I really like AMD at this price and over the long term. Alibaba Group, ticker BABA, is also going to report its earnings on Tuesday after an 87% run in the shares since the October low. We've been following this for the last couple of months on that China reopening story. The economic reopening in China could take this rally even further, and BABA is still attractively priced. Okay, even after that 87% run, it is still well below the long-term price targets and the long-term valuations. The regulatory environment is also looks like it's cooling, with the potential for the company to IPO its Ant Financial segment here in the next year. It was ready to IPO that unit to spin off those shares of Ant Financial a couple of years ago. That fell through with this greater regulatory scrutiny by the Chinese government. I think it could now happen over the next year and add significantly to these shares, to the sentiment for this stock. I own the stock. I've got the stock at least up to 150 or 175 over the next year. Medical Properties Trust, ticker MPW, another one we've talked a lot about the channel. I own the stock. It's going to report its earnings on Thursday with the shares up 13% since highlighting this in December as one of the stocks I use to pay my own bills, right? Shares did get slammed over the last year along with most real estate stocks, but are now rebounding into this new year. And this is one of the best dividends you're going to find in REITs with an 8.9% dividend yield. I like the long-term outlook for appreciation in that healthcare property segment, and I think this is one to own as well. Heavyweight Amazon, ticker AMZN, is going to report its earnings on Thursday with expectations for just 17 cents a share. That would be a drop of 87% from the same quarter last year. That's on expectations for a 6% increase in revenue to $148 billion. So again, the same thing we're seeing everywhere with inflation pushing revenue up and sales up higher, but then a huge drop on earnings because of those extra expenses. That spread between the sales and earnings seems overblown, just like it does with AMD. I'm expecting the company to report closer to at least 20 cents a share. The shares are up with the rest of the market, but still trading attractively priced on a price to sales basis. We've talked about this stock in the last couple of weeks. I own the shares. What I'm really excited about for Amazon is what management is going to say for its ad revenue business. Okay, this has been the big shock lately for Amazon. The big shock last quarter was that ad revenue, revenue from advertising was up 18% on a year-over-year basis. A totally different story from what we've been hearing from Facebook and Google that have reported slower revenue growth in the advertising segment. That means Amazon is taking that market share from those heavyweights, those advertising heavyweights, Facebook and Google, getting into the advertising game. Those margins, the profitability on advertising revenue is much higher, upwards of 30% versus a lot of the other segments that Amazon is in, where its overall profitability is only about 2.5%. So I think that the growth of this ad revenue business and what management could say about that in this earnings report, I think that growth is really going to take earnings higher and surprise the market. We can look at what the sectors did last week for that big picture idea. Here we are on the sector tracker for sectorspider.com. We're out here at the 5-day period, and just 2 of the 11 stock sectors closed lower last week, with investors really selling out of those safety sectors to fuel their rebound bets into last year's hardest hit stocks, right? We saw consumer discretionary boom, 6.5% higher, communication services up 4%, really drawing investors out of some of those safety sectors where they held out for safety last year, like healthcare and utilities. Both of those down. Now, that weakness in consumer staples stocks is more than just profit taking, though. Consumer staples up just 1/3% last week, but very much feeling the pain over these last few weeks. We're hearing of steep earnings slowdowns from a lot of companies reporting the fourth quarter earnings in this sector, like Campbell's Soup, Colgate. We can zoom out here to consumer staples and look at the year to date. And you can see here some of these Colgate-Palmolive down 9%, Procter & Gamble down 7%, General Mills 7%, ConAgra Brands and Pepsi down about 6% each. A lot of these companies normally very stable cash flows, but we're hearing the same thing as they report earnings, and earnings slow down from these companies, not able to cover those inflationary costs, down more than 7% this year. Negative sales and earnings really being seen with those high stock valuations. This sector and the stocks in this sector did not fall as much as other stocks, so they are still very high valuations here, and investors are rushing to the exits. That said, I am looking at this 15% rebound year to date in the stocks in the communication services and consumer discretionary sector, and wondering if they're just a little bit ahead of themselves. Here we can see the stocks in the communication services sector up 15% so far just this year. Some of these stocks: Warner Brothers Discovery up 57%, Paramount up 36%, with Match Group up 30%, Meta Platforms, the old Facebook, up 26%, Netflix and Disney up 22 and 26%. So a lot of these streaming stocks, a lot of the social media stocks up from depressed prices. And while I like the sector this for the whole year, I'm not sure that the earnings are going to justify that strength in the rally just yet. We've yet to hear from most of these companies in the group. They're going to start reporting their earnings over the next couple of weeks here, and a negative outlook for these first 2 quarters could take back some of those recent gains. We are still seeing an adpocalypse in the advertising segment. Ad rates are down something like 20 or 30%. A lot of these companies are going to have to report those lower earnings for the fourth quarter, and might have to warn for the first and second quarter that those ad revenues are going to be lower. Same could be said for the stocks in the consumer discretionary sector. They're up 14.5% so far this year. Retailers had an abysmal fourth quarter, and the first 2 quarters are likely going to be weak for the retail segment. Unless management can really spin that focus to the end of this year on that rebound in earnings, this stock rally for these 2 sectors could fizzle out in the next couple of weeks when those companies report their earnings. Again, going to be a very busy week for earnings there. A full 1 in 5 stocks in the S&P 500 reporting their earnings, but all the focus is going to turn to the Fed on Wednesday as it wraps up its meeting. We can see here on the CME group, the CME Fed Watch tool, showing us these market-based probabilities for Fed rate hikes. We can see that it is nearly unanimous. The market believes 99.9% that the Fed will raise its rates by 0.25%, 0.25%, to a high on the Fed funds rate of 4.75%, whereas just a few months ago the market expected this to be the final Fed rate increase. Now we are looking at March. Now we are looking at a 85% probability that the Fed raises another 0.25% there in March for the last Fed rate increase, up to 5% on the federal funds rate. So we do expect Chair Powell to talk about this when they wrap up that meeting on Wednesday, raise rates, and he gives his conference, while Chair Powell is expected to reiterate that need to keep rates high until inflation comes down. He's also likely to point out that inflation has clearly trended lower. We have had several CPI, several PCE reports that do show that that inflation is trending lower, moving closer to that target. That confidence should help support stocks on the idea that the price pressures will not keep the Fed from eventually cutting rates, probably next year. Click on the video to the right for my 7-stock forever portfolio. 7 stocks I'm buying no matter what for that long-term returns. Don't forget to join the Let's Talk Money community by tapping that subscribe button and clicking the bell notification.